Modern equity markets are no longer primarily driven by long-term investors making fundamental judgments about business value. Instead, chaotic, interlocking mechanical gears are swallowing the organic process of price discovery. Short-term price movements have become the product of mechanical flows rather than a rational assessment of intrinsic value. The options market has expanded to a scale where 59 million contracts trade daily, representing a massive shift in how capital moves through the system. On peak days, the notional value of S&P 500 index options alone crosses $1 trillion. This figure often exceeds the total daily trading volume of the actual U.S. stock market. This derivative growth coincides with a market where algorithmic and systematic trading now account for 60 to 80% of all U.S. stock volume. Our objective is to map this mechanical plumbing, identifying the specific flows that create the mispricings that patient investors can exploit. Intraday market volatility is not providing data on the economy, it is providing data on the market's automated machinery. To understand this machinery, we have to look at how market makers manage risk. When an investor buys a call option, the market maker on the other side takes on short exposure, meaning they lose money if the stock price rises. To neutralize their risk, they use delta hedging. This is an automated process where the market maker buys shares of the underlying stock to balance their options exposure. As the stock price moves, the amount of stock required to stay hedged changes. This rate of change is known as gamma. When a stock's price rises, the market maker's risk increases. They are mathematically forced to buy even more stock to maintain a neutral hedge. This creates a gamma squeeze. Dealers buy stock, pushing the price higher, requiring even more buying, a self-reinforcing feedback loop. In a long gamma environment, dealers operate in reverse, buying dips and selling rallies, which acts as an artificial dampener on market volatility. Under short gamma conditions, dealers must sell into market declines to hedge their positions, which dramatically amplifies downward crashes. Institutional desks now use the GEX, or gamma exposure signal, to calculate the net position of all dealers and predict if the market will be calm or violently unstable. Because options hedging volume is now so massive, these market makers have become the primary price setters for major equities. This means sudden price spikes are often mathematically mandated by dealer balance sheets, occurring regardless of a company's actual earnings. Second-order flows also dictate market direction, beginning with changes in the VIX. The VIX is an index representing the market's expectation of near-term volatility based on S&P 500 options. When the VIX drops, a metric called Vanna forces dealers to buy stocks to re-hedge, creating a mechanical upward drift that has nothing to do with economic news. Similarly, Charm describes how an options hedge requirement decays as it approaches expiration, forcing dealers to shed positions and altering end-of-day price action. The most significant accelerant is the 0DTE, or 0 days to expiration option. These contracts now constitute 51% of all S&P 500 options volume. Because 0DTE options expire the same day they are traded, they concentrate explosive hedging risk right at the current stock price. This chart shows the S&P 500 from 9:30 a.m. to 4 p.m., illustrating how 0DTE hedging concentrates price swings in the final 30 minutes of trading. Research indicates that 0DTE hedging can increase annualized realized volatility by over 6.4 percentage points during these brief windows. The chaos seen at the end of the trading day is not a result of human panic, but a mandatory mechanical settlement of billions of expiring bets. While options dealers set the price, systematic algorithms and passive funds execute 80% of the actual trades. This creates predictable distortions during index rebalancing, where algorithms front-run the mandatory buying of passive ETFs on known public dates. There are also CTAs, or commodity trading advisors. These trend-following funds manage hundreds of billions using identical price momentum signals. When a stock price crosses a key threshold, like a 200-day moving average, CTAs trigger simultaneous selling. This creates factor crowding, where hundreds of disparate AI models independently arrive at the exact same trades because they are mining the exact same data. Volatility targeting funds then detect this selling, observe a spike in volatility, and automatically reduce their equity exposure, adding even more selling pressure. This chart shows the result of a mechanical liquidity vacuum. During periods of stress, high-frequency trading market makers often pull their bids. HFT firms use ultra-low latency algorithms to provide liquidity by exploiting microsecond pricing discrepancies. A minor 2% dip can cascade into a 5% crash because layered algorithms are mathematically forced to sell to one another. AI trading agents can now evolve synchronized strategies autonomously without a central command. They process millions of data points to exploit the market's mechanical routines. One method is AI-enhanced spoofing and layering. Spoofing involves placing large orders with no intent to execute them to bait other participants. AI can place and cancel millions of these fake orders per second to move the price. AI can also launch adversarial attacks, engineering small price movements specifically designed to trip the stop losses of CTA trend-following models. AI-generated financial deepfakes can inject false information. A synthetic video of a central banker announcing an emergency rate cut could move markets by billions before being identified. Self-optimizing algorithms can also learn to collude and manipulate prices through AI herding, achieving coordinated behavior without being explicitly programmed to do so. This creates a critical regulatory gap. Existing market abuse laws require human intent, which is difficult to establish when dealing with emergent behavior of black box AI. Adversarial AI now actively hunts the predictable, automated routines of competing trading systems. The primary defense against mechanical market noise is extending the duration of the investment horizon. Over a 10-year period, the daily impact of gamma flows and spoofing fades, leaving only the reality of business fundamentals. Focusing on quality, businesses with low leverage and strong cash flow provides a structural defense, as these companies tend to recover quickly from non-fundamental sell-offs. Investors who map these mechanical distortions can use them as systematic entry points. This includes buying high-quality stocks when a CTA algorithm is mathematically forced to sell at a 200-day moving average. Another tactic involves accumulating positions during OPEX pinning, when a stock's price is artificially compressed near a strike price due to options expiration. This technical data shows a buy imbalance during a major market drop. Maintaining liquidity allows an investor to deploy capital during VIX spikes caused by mechanical de-risking. Investors should also be skeptical of financial media narratives. Outlets often invent macro explanations for price moves that are actually driven by dealer hedging. To defend against AI deepfakes, strict information hygiene is absolutely necessary, requiring primary source verification of all market-moving news. The market machine is the modern equivalent of Ben Graham's Mr. Market, a mechanical entity that regularly offers high-quality assets at a discount to those patient enough to understand the plumbing.